In this presentation, we will continue on with our S Corporation Comprehensive Problem, Part 7. This time we're going to be recording depreciation, both book depreciation and depreciation for the tax return. There will be a difference between the two, and we're going to have to record that in our system as well. We will be inputting this into tax software, Lacerte being the tax software owned by Intuit, the owner of QuickBooks. The process of entering this data into a software program, calculating the depreciation with that tax program, and recording it will be similar with other types of tax software as well. You can also enter this information just using tax forms, which we will provide, or that you can find on the IRS website, irs.gov. Here is our 1120S so far. You'll recall last time that we entered the income statement in prior presentations in accordance with the book statement that we have thus far. And you'll note that there's nothing in the depreciation. We had no depreciation recorded. Many times people will be reliant on the tax software. So in that case, if you're working with someone who's reliant on the tax software to record the depreciation, if they were a customer or a client we had last year, then all of the prior year data that was in there in terms of the fixed assets, which are going to be recorded the depreciation on, will already be in the system. And then the system will record the depreciation. In other words, we often are reliant on the tax software to record depreciation. Now, smaller clients will often just use the tax depreciation, even though it's not the best kind of method in terms of the matching principle for financial accounting, because it's the easiest thing to do. So oftentimes there's accelerated depreciation in the tax code that's going to be beyond what you would expect for financial accounting. However, again, to have two sets of depreciation schedules is a little bit confusing. Therefore, small clients will probably just be using tax depreciation. However, it's common then, if you want a different depreciation schedule to have a better matching principle according to normal financial accounting, then you could have a difference between the depreciation. Again, the tax software could calculate both of those items. So if we were talking about a continuing client, then we would typically already have the information in the system for prior years in terms of the fixed assets. Then we would need the current fixed asset changes, which are usually pretty limited. What types of large equipment and whatnot did you buy in the current year? And what types of disposal sales of large equipment did you have in the current year? Usually there's not too much activity. We just add that to the schedule and push forward. So in this example, we haven't put anything in the depreciation schedule yet. So just note, if we go back to the software, then if in the current year there was no depreciation recorded, then the software, if we had input something in the prior year, the schedules were already there, then it would be printing something automatically in depreciation. And the first step we wanted to do was tie out to what the current financial statements have that were given to us. Therefore, we forced depreciation to be 0. So if there was anything in the schedule, we could force it to be 0 to tie into the net income number. And then we're going to go back in and think about the depreciation calculation and unzero this out in such a way that we'll be able to tie out as we go. So that's going to be the plan. And we also forced on the balance sheet the depreciation calculation here as well. We're gonna get rid of these overrides once we let the system do it, and as we do that, then we'll be able to figure out what's going on without that process kind of messing us up or throwing us off balance. So let's see what that will look like. If we go back to our system here, what I'm going to do is unhide some cells. I'm going to unhide the cells between here because we're going to need an adjustment. I'm going to go from L, I'm going to select L to Q, let go of the selected area, right click and unhide it. So here we have it. Now what I'm going to have is an adjusting entry, because the adjusting entry is going to be recording the depreciation on a book basis. So we're going to actually record something that's going to be an adjustment to the books in order to get the books correct on basically an accrual basis. And then we're going to have to record the difference between the book depreciation and the tax depreciation. So let's see what that would look like. This is how I would suggest doing that. We're going to be concentrating on these accounts. I'm going to go ahead and make them a different color. Let's say we're going to make the ones we're concentrating on orange. Let's say I want this account and this account. That's the ones we're going to be focusing in on at this point. And we know that we have depreciation of $100,000 on property, plants, and equipment. Now I'm just going to put this into a one-time line item of the $100,000. So just be aware that this could be multiple things, right, in the depreciable assets, we might have a ton of things in depreciation. We could have a course in and of itself on, tracking the different types of depreciable assets. But here, I just want to show how it's going to be related to the tables that we're going to have to put in the depreciation tables and how the tables will then be calculating. So we're going to go back to our software, and I'm going to go into the balance sheet, and I'm going to go into the deductions, and we want the depreciation. So we're going to go into the depreciation, and then I'm just going to add the list of items. Now, in practice, if whatever the list of items were, if it's a forklift, we want the forklift. We probably want the number for it. If you have multiple forklifts that you're going to be putting in, say they've purchased multiple, like 3 forklifts at one time, you don't want to put 3 forklifts. You want to put each forklift individually on there for the cost. That's really important because when you sell the forklifts, you're not going to sell all 3 of them at one time. So if they purchase a lot of equipment at one time, you don't want to put it on there like it's equipment all at one time. And if it's a bunch of different stuff, you want to identify the specific equipment that you should have, and you should do that because they're large pieces of equipment and they should be easily identifiable. And that'll make it a lot easier when something is sold and they sold one of the 5 pieces of equipment. You don't have to go back in there and worry about the fact, well, I grouped them together when I put them on the books before, and now I got to take them apart. It doesn't matter if they're in the same category or if they're going to be depreciated under the same method. You want to break them out in practice. Here, we're just going to put on the one piece of equipment. So we're going to say it's a forklift. It's a one piece of equipment. We're going to say it's on form. It's going to go to the form 1120S. The category we're going to call it the machinery and equipment. We're going to say the date, place, and service. Now, we had this on the books last year. Now, normally, what you would like to do if you had any depreciable assets is put this into the prior year software and then tie in the depreciation schedules and then roll it forward. We're not going to do that here. We're going to try to tie into the prior year depreciation just in the current year for the example problem. So let's see what that looks like. I'm going to say, in other words, we purchased this last year, not this year, 01/01/18. I'm going to say for, January 1st, 2018. Now, the way the depreciation schedules typically work, or the maker's depreciation, is typically to use a mid-year convention. So no matter what date, if it was in 2018, it'll typically have depreciation for half the year of 2018 and the full depreciation for 2019. You also have to consider things like 179 deduction and special depreciation. We're not going to get into those items here. That's kind of like a whole topic in and of itself. But the bottom line is that if you have the depreciation schedules for a new client, then you have the added problem of matching out the depreciation schedules to what were in there last year, and then moving forward will be fairly easy because you only have to deal with new purchases and disposition and disposals. So then we're going to say the cost is going to be $100,000. I'm not going to put anything in the 179 and the prior year depreciation. Now let's see what it calculates for us. So if we go to the forms, then I want to go to the depreciation schedules down here. I'm going to look at the depreciation schedules. And again, if you have a new client, you're going to need these schedules. And if they want to differentiate between the book and the tax, then you're going to need both schedules for the book, the tax, and possibly the AMT in order to properly input this. So we're going to go into the regular calculation. It may be a little bit small, but you can see here that we have the cost of $100,000. If I scroll to the right, we have the basis of $100,000, and there's no depreciation being calculated. Let's go back. I seem to have missed a couple cells here. The method, we're going to say, is 7 years makers. It's going to be 7 years makers. That's the one we want. Okay, let's try it again. Go back to our forms. And there we have it. So you can see it's 200, basically double declining, and it's going to be a half-year convention. So we purchased it last year, so it had a half-year convention of depreciation, or it should have a half-year convention of the depreciation in the prior year. You'd notice I don't have any depreciation in the prior year, and then the current year is at the 24,490. What I'm going to do is enter the prior year depreciation now, and note if I go back here, I know there was depreciation in the prior year of, in this case, the 19,592. So I'm going to go ahead and enter the 19,592 and let that, and then it'll roll forward in the current year. So the 19,592, I'm going to go back here and say that the prior. So it's going to be down here, 19,592, and then I'm going to go back up into the forms, and there's the prior year depreciation, the 19,592. Again, you might have to put that. It'd be best to put this in the prior year software and match it up to a depreciation schedule such as this in the prior year, then roll it forward. And that means that the current year then is now calculating from the software at the 24,490. So we're going to calculate the current year depreciation for taxes at the 24,490. Now, if you have a client that's recording their books on basically a tax depreciation schedule, then you're going to record that for the book depreciation as well. However, if they want to use some other kind of depreciation method, then you'd have the book depreciation method, which would differ from the tax depreciation method. In this case, we've got the book depreciation basis of the 100,000. Now the book depreciation, I'm going to use a straight line method. We're going to have the prior year depreciation still at that 19,592 because that's what's currently on in the books here. So we're going to calculate from there, and then I'm going to go back to the forms just to show a difference. So now we have the prior year depreciation on the book method is the 19,592, but the current year is only 14,290. So we'd like to use a book method at this 14,290, which is going to differ from the tax method in this case, which is going to have a current year of the 24,490. So how are we going to record that in our system? Let's start with the book depreciation. So we're going to go to the book depreciation and actually record that into the adjusting entries. And again, note that you're not always going to have a difference. Some smaller clients are just going to use the tax basis, and that would be an easier thing to do. We're just going to have the difference here, use it a straight line for the book in order to show if you have that difference. So we're going to say that it's going to be 14,290. Going back to our software, we're going to say, all right, we need to make an adjusting journal entry. This time we're going to record it to the adjusting column first. And so this is going to be actually an adjusting entry. I'll designate that with an A as opposed to a T for the tax entries. And then I'm going to say that we're going to need to record depreciation. So there's the depreciation and accumulated depreciation. So this is going to be the depreciation that we're used to basically seeing this type of transaction and adjusting entries. So if you got questions on that, we've got courses on depreciation and depreciation calculation. 14,290, so we got 14,290, and that's going to be the debit and the credit. So I'm going to scroll back down, and we're going to record this in the adjusting column. So I'm in N25. I'm going to debit the N25. That increases the depreciation, and it will decrease the net income from here down to here. And then the other side is going to go to accumulated depreciation in N12 equals, that's going to be the credit, and that's going to be increasing the accumulated depreciation 19,592 to 33,882. All right, so that's going to be our transaction. Let's go ahead and then unoverride in Lacerte, and let's see what Lacerte does. I'm going to go to Lacerte, and I'm going to say that we go to the data input. We want to remove then on the balance sheet, I'm going to remove the calculation in year 2, this override of the 19,592. I want to remove that. And then in the deduction section, we overrode and we forced it to be 0. And we want it to now calculate there as well. So I'm going to delete that. Those are the two sides, depreciation and accumulated depreciation. Now, when we're out of balance, if something gets out of balance, we know where it is. It has to do with those two areas in this journal entry. So if I go back to the tax forms then, where's this going to affect on the tax form? It's going to be on the 1120S. So if I go to page 1 of the 1120S, we know that we have depreciation being calculated, but it's being calculated at the tax basis. So that's not something that we're going to change now because we haven't entered the tax journal entry. We entered the book journal entry. And then there's going to be an M1 adjustment involved here because there's going to be a difference, you would think, between the tax and the books. And you'll notice, wait a second, there isn't an M1 here, which means it's not calculating the difference between the tax and the books. And if I go to then the balance sheet, and the balance sheet, which is in Schedule L, to see if we're in balance, it does look like we are in balance, but it's not calculating that M1 adjustment that we would like. So what I'm going to do is I'm going to go back and say, well, the difference I would like to see here is an M1. I would expect to see that. So I'm then going to go to the balance sheet, and I'm going to say that I want to basically go to the miscellaneous section and tell Lacerte, yeah, I would like to use the book depreciation and show an M1. So the books are going to be different than the tax depreciation. Then I'm gonna use that with this number 4 there, and then I'm gonna go back to the form. Now we're still in balance here, but there should be a change. There should be an M1 adjustment happening. So if I go to number 5, page 5, we see this difference now in the depreciation of the 10,200. So there's the 10,200. So now I'm going to go back to page 1, and I'd like to tie in for the taxes to this 24,000 in depreciation. So what I'm going to do there is we're going to go back to our worksheet, and what I need to do is reverse this for taxes. Now, you could just record the difference. It's easier, in my opinion, to say, hey, look, this is the tax depreciation, the 14,290. I'm going to reverse that. So I'm back to the book depreciation, and then I'm going to record the entire tax depreciation rather than recording that difference. To me, it's easier for me to see that. So let's see what that would look like. I'm going to say, all right, now for taxes, I need to record the tax depreciation. It's easiest for me to reverse this exactly the way it is. I'm going to put the credit on top because I want to reverse it from top to bottom just like we have it here. So I'm going to say, here it is. I'm just going to reverse that entirely. I'm going to credit the depreciation. Let's do it this way. Credit this, and I'm going to debit this. So I'm just reversing that journal entry, and I'm going to keep it in this format. And then I'm going to do that on the tax column now. So on the tax column, I'm going to go to the depreciation, and I'm going to reverse what happened. So we recorded the depreciation here. Now in this adjusting entry, I'm going to say equals, and I'm going to reverse it back to 0. So that it goes back to 0 for taxes. And then up top, I'm going to record the other side in P12, and I'm going to reverse this thing back to the 19. So here's the 19 and the 19. Then I'm going to record the, and you may want to put a note there, down here and say, call it a reversing entry. And then I'm going to say that for taxes, I'm going to record the depreciation, which is going to be this and this on the tax basis. And if we go back to our schedule and we go to 2019, the tax depreciation that is recorded, which we can find here, is going to be the 24,490. Now, if you have 179 deduction, you got to take that into consideration when you record it as well. That, accelerated depreciation for taxes in some format. Here, we're going to just say the 24,490. So this is going to be 24,490. That's going to be the depreciation, normal kind of journal entry now that we would typically have. Debit depreciation, accumulated depreciation expense. We're going to go back down here to P25. I'm going to double click on it, go to the end of it and say plus, scroll back up and pick up that debit. So now we got this recorded at the 24,490. And then I'm going to go into the accumulated depreciation, double click on it, go to the end of it plus, and go to that 24,490, bringing it up to the 44,82. So now we can go back in and see if everything ties out for us. So I'm going to go back in and say, all right, now if I go back to the tax form and I go up to the 1120S, we see this 24,490. That's what we have in depreciation expense down here, 24,490. And then let's take a look at our bottom line numbers. If we go down to the bottom line number, we're at 75,510. So that's going to be the 75,510 for tax purposes. And then if I go back over here and I go to page 3, there's the 75,510 for the Schedule K. The bottom of the Schedule K is also at the 75,510. So there's no adjustment there. It's basically the same number. So but we do have an M1 adjustment. And then I'm going to say, well, the balance sheet is in balance. That looks good. In terms of the fixed assets, I've got 100,000 for the fixed assets and then 33,882. So 33,882, if I go back up, those are going to be these two numbers. We got the 100,000, the 33,882. Note the balance sheet, the Schedule L, is recorded on the book basis, not the tax basis, right? And so I'm going to say that these two have now been recorded correctly. And I didn't force this number in the software. The software calculated it. I gave it the beginning number. It then calculated the proper amount of adjustment and gave us the 33,882. Then I'm going to go back to the software and say, all right, how about the M1 down here on line 5? The M1 starts at the 85,710. That's the book. So let's go down to the income. 85,710. That's adding up the entire everything below the equity. So 85,710, and then on the other side, we've got the 75,510. 75,510. So we can see the reconciliation process happening here. So that's the depreciation, and that's pretty much the most complex kind of item, especially if you have that difference between book and taxes, and especially if you're entering the depreciation for the prior year, where you have to match everything else out to the prior year depreciation schedule. And so we're going to have some other adjustments which will have a similar kind of characteristic to it, but because of the different components of the depreciation, that long schedule, that's probably the most difficult one to make sure it matches up. You want to basically attack the depreciation or go at it having already been in balance, so that if the depreciation schedule, messing with depreciation, calculating depreciation in the system throws you off, you know that it's isolated to just the depreciation calculated. That's what the problem is. It's not anything else, and you can isolate that. And then if you're having a problem, reverse that to being back in balance. That's how you want to think about all these kind of adjusting entries.